everyone. It's Robert Fisher with the RJF team with Keller Williams Realty here. Today we have a special guest. I wanted to invite Carson on, Carson Vaughn. He's with Guild Mortgage, and he helps a lot of our buyers buy homes, a lot of our investors, very wise on the market. And Carson, I just wanted you to introduce yourself and kind of answer the question right now, like what's going on in our market? Rates have changed a little bit.
Yeah, awesome. Well, first off, Robert, thanks for having me on here. Super honored to get to talk to you and the folks that follow you and trust in you. So I'm appreciative of the opportunity. Again, my name's Carson Vaughn. I'm with Guild Mortgage. We're a mortgage banker lender out of Austin, Texas. So we're local here. And I've been in the business a little over 20 years. So Robert, much like you, we've certainly seen some cycles and we've seen some of these seasons. And, you know, this is just another one of them as we're starting to see some slight changes in the market. Specifically what we've seen over the last, let's say 6 months, is we've seen rates on a typical 30-year mortgage go from about a 3% rate, let's say at the beginning of the year, to just north of a 6% rate. So rates have doubled.
Yes.
And that does have an impact on the market. That has an impact on people's payments, and it has an impact on if they want to buy or not, and how much house can they afford. So
it's been interesting. I made another video kind of talking about the amount of change we've seen. I would almost say the change that we've seen in the last 2 years has been more than what we've seen in a 20-year cycle. Is normally every 7-10 years we see a shift and things go on, but COVID hit, we slowed down, then we sped up, and then we really sped up, and then we slowed down again, then we sped up, and all this other stuff is going on in our world, and just pandemic, everything. And so it's been pretty crazy. So consumers are kind of looking up and going like, there's been a lot going on. What should I do? And so if right now we have that question, so what does that mean? Interest rates are higher, they're doubled. Should we buy? Should we not buy? What do you think on that side?
yeah, great question. And to put it into a little bit of context, if you were to look at where rates have been over history, they're still really, really good right now. Now, that certainly doesn't feel good if you were comparing it to the last 5 to 10 years, when rates probably averaged in the 4s and rates are now in the 6 range. But an oversimplified explanation of why rates are kind of where they are today is that COVID hit, and we had the government as the Federal Reserve, the Treasury, in an effort to help with the recovery, right? An economy that was basically shut down overnight. To help with the recovery, the government started buying mortgage-backed securities, which is a fancy term for what kind of drive. They're the instruments that drive interest rates. And so they started buying them, and they bought a lot of them. And they did this last time in 2008, right, with the financial collapse and the financial crisis, and it was very effective. And what it does is it drives interest rates artificially low. And so it was responsible for bringing rates down a couple percentage points, maybe from 4.5 or 5% down to like 2.5%. And that caused rates to go down, which means your affordability your homes are more affordable, right? It drives down the cost of owning a home. And people then began to look at, hey, I can buy a $100,000 more home, for example, Robert, and my payment only goes up $200. Or I can buy a $300,000 more home, and because rates are low, my payment only goes up $600. So it was a catalyst that spurred, right, all the home buying and demand for homes like we've never seen before, right?
No.
And that drove prices way, way up. And then now here we are, and all of that activity has caused a concern for inflation. And so now the government's trying to cool the economy, but not force us into a recession. And so it's a balancing act, right? Inflation report on Friday was, or on Monday was 8%. And if you take out a couple of the key measures like energy and food, it was like 5%. They want that number to be 2%. And inflation's what things cost, right? Relative to a year ago, relative to a period in time. And that means that things are costing 8% more than they did cost, if you were to look at it year over year.
So what do you think they're going to do? And I know no one has a crystal ball, but like, what do you think they're going to do the rest of this year?
So it's a balancing act. You probably have heard the Feds raised interest rates. They raised them 0.75%. The mortgage industry already has priced in a lot of what the Feds will do this year. So the expectation is they will continue to raise rates from, let's say, 1.75% on a Fed's rate to maybe 3% on the Fed's rate, right? That's the rate that banks lend each other overnight, lending each other money. It's not the mortgage rate, but it does have a ripple effect. And so we see rates go up, but we've already priced that in. It's a really tough question. It's not one that really the experts can even answer. It depends. If this last little hike in rates causes things to slow down enough without slowing down too much, then we'll kind of flatten out and feel the rate we're at now in the sixes for the rest of the year.
So then what we've had a couple of clients ask then, okay, so I'm looking at this. So should I buy, should I not? And you know, what are your thoughts? And I'll give my own thoughts here in a sec too, but I'm curious what you.
Yeah, from the mortgage side, it's been so hard in the last couple of years, right? When there's so much demand for homes, the sellers have multiple people to pick from, right? Multiple offers. And so they many times will pick the best offer and the strongest borrower. When things slow down and there aren't as many offers, if you're the only offer of only one of a couple, you now have such a great opportunity to have the ability to buy with maybe minimum down. See, over the last couple of years, we noticed that there was a segment of buyers, a lot of first-time home buyers that didn't have a huge down payment, that really just didn't have a fair fighting chance to get their offer accepted. And broke my heart, for example, like a veteran borrower that's a zero down loan that has served their country and is so deserving of their VA benefit, which is a VA loan. It's an amazing loan that doesn't have mortgage insurance. It's a really good payment. Rates are low, but many sellers chose to go with a client that had 20 or 25% to put down. So all that is in a way of saying, hey, buying isn't for everybody, but if you've wanted to buy over the last couple of years, you actually have a great opportunity if you weren't in a position to put a big down payment and maybe waive the right to back out of the contract if it doesn't appraise. You see, it got so crazy over the last couple of years. People had to say, hey, I'm going to buy this no matter what it appraises for.
Yes.
If you don't have unlimited funds, then you have exposure there. There's a lot of risk there, right?
Well, and that was my thought too. Again, I totally agree. I don't think I also think not everybody should buy, but if you are able, you're qualified, and it makes sense, and this is still part of your family plan, it still makes sense. And the reason why is just, again, for the last 2 years, you haven't been able to get in a home, and so it's one of those of I really wanted a home, I couldn't get it. For a lot of people, putting down FHA, even 3.5%, 5%, 3%, whatever people are doing, much less a VA loan, but they couldn't get in, like you were saying. And now they have a little bit more of the control. Prices have kind of plateaued. Some places we've seen more price reductions. I think yesterday, and in 24 hours there was like 234 price reductions on the MLS, and so in one day, and so that was a really big deal. And so the buyers now have more control, and they don't have to fight against 20 other offers, 30 other offers. And so if this is still part of someone's family plan, like, this kind of locks in your future, in my opinion, of like, now I know I can get a home, here's where it's at. It's still good for the sellers too, because they're still, even if they have to dip down a little bit, they're still at historic highs. So it really seems like a good opportunity. But what happens if I buy now today because I find my dream home and I finally don't have to compete, but interest rates go down? Then is that just horrible, or what can I do?
Yeah, great question. And when you think about renting, right, it's like you're at the mercy of paying rent at whatever the landlord charges, right? But so you don't have a lot of control there, right? But with owning a home, if rates go down in a year, if rates go down in the next 2 years, and look, the consensus right now is that rates will go back down. Like, this is just like lowering rates was artificial to help with the recovery. This is a direct effort in cooling the economy, and rates have gone up, and that will, as things slow down, rates have to come back down. And so you always have the opportunity to refinance your mortgage down the road to lower that monthly payment if rates do, like if rates go down 1%, it usually makes sense to refinance to lower your monthly payment.
When I've heard lots of financial people say this, lots of people just because the other side is like, well, and again, there's not one pat answer for everybody, but some people say, well, if that's the case, maybe I should wait. And I've heard a lot of very smart people say, like, you can't time the market because if you're waiting for the interest rates to go down, then what do you do if the prices go up or it gets competitive again and then it's multiple offers or whatever? And so, again, my take from the real estate standpoint is if it is your family's plan and if you're going to be doing it in the next 1 or 2 years anyways, today helps you kind of lock everything in. And there's pros and cons of what that looks like. So, and and this is one of our other videos, we talked about this where I had in a 2-week time frame, I think it was, we spoke to 10 sellers and buyers. They were going to sell and buy. And I think 7 of them, once we went through their goals, it made sense to go buy and sell. And they were actually relieved once we could actually talk about it. 3 of them, it didn't make sense, and that's okay. You mentioned, this is one thing I had you send to me, which was so big because people are just saying, you know what, I'm just going to rent right now. This is what it looks like. And
yeah, and so we can be more specific, and this has assumptions built in, but what this is comparing is over a 10-year period, and specifically we drilled down right at 7 years. I think that's the average time that people own a home. I think the average time people have a mortgage is somewhere right around 5 years because they typically will refinance, but they stay in their home longer even if they don't have a mortgage for the whole period they have a home, right? They don't have the same one mortgage, right? So what this is comparing is if you were to buy versus renting. And from a big picture standpoint, it takes into account, like, what does it cost you per month to rent over those 7 years? And it factors in what is the likely increase in rent. And it took the average for Williamson County, which was a 4.5% per year rent increase. And so we pulled the data for the local area, and which happens to be about the same as Travis County as well. I have a sneaking suspicion, Robert, that with what property taxes have done, like in Travis County, they're up a little over 40% increase in valuations, which means the property taxes, on average, we're talking about a $500,000 home in this scenario. And so 40% increase is a couple $100,000, right? And the property taxes on that would be an additional $5,000 or $6,000 a year.
yes.
So for that landlord to still just be neutral and make the same amount of money, they would need to raise rents by $500. And so I have a sneaking suspicion that we're going to see a larger than average increase in rent. But that's okay. This scenario is a calculator of if you were to rent right now versus owning. And it'll take into account what does it cost you to buy. And in this scenario, we use 10% down. What does it cost you to borrow the money from the bank? And in this scenario, we used a rate of 6.25%, just a little over 6%. So we're being conservative. We're not showing you rates from 3 months ago. And if you were to buy a $500,000 home in this example, that puts your monthly payment, if we scroll down just a little.
Got it. Okay.
And then we assume that rent, so it would cost you in theory $3,700 a month, $3,800 a month, all in to own a $500,000 home with 10% down.
Okay.
Okay. And then if you were to rent, if you look to the next column to the right, we're budgeting about $3,000 a month to rent, plus the cost of insurance, right? Because assuming you insure your contents of a home, if we're counting insurance, if you own, we're counting renter's insurance here as well to try to keep it apples to apples, right?
Yes,
we're not counting utilities and energy bills and all that other stuff. So basically, right now, using our assumptions, we're showing that, hey, it might cost you $700 a month more to own this home. But if you were to look over time, if we scroll down a little, we're projecting that with an annual rent increase of 4.5%, which I think it's going to be more than that, we're showing that in 7 years from now, your rent's going to be more expensive than your mortgage payment. But if you go down and look at a really conservative, right there, that appreciation gain, here's where the magic happens, right? If you bought a $500,000 home and you put $50,000 down, this is showing that you're going to gain at a very modest appreciation rate of only 4%. That same home now in 7 years from now will be worth $657,000. And that's right where that cursor is, right in the middle of the worksheet that you're looking at.
Yes.
Now, if you sell, it's going to cost you money to sell in 7 years from now, right? And so it factors in a typical cost to sell and factors that out. That's what's in red. And then if you go down to the bottom of the charts, those bar graphs there, it takes into account, hey, how much do I pay my loan down? How much does the home go up? What's my cost to sell? And then you can look at over a period of time. And what this tells you is like, look, if you were to buy a home and sell it in the first couple of years, that doesn't make sense. But the longer you're there, the bigger your win is, if you will. So over 7 years on average, if you look at that darker green column, it's showing that, hey, you'll come out ahead about $151,000 using pretty conservative estimates over a 7-year period. And if you look at over 10 years, because of paying your loan down and having the opportunity for the home to appreciate a little more, another 3 years and that number jumps by over another $100,000.
And that's a big deal. Why I'm so passionate about this too is just I read an article that talked about like the average net worth between a home renter and a home buyer. The difference is like $200,000. Like it was huge. And so these are things that can, if you use this money right and keep it going forward, like this can be wealth passed on and to the next level if invested properly. And to my knowledge, I don't think I've asked you this. This doesn't include any potential of being able to write off a certain amount of taxes, your interest, and that doesn't include any of that stuff on the tax side, right?
It's actually pretty fancy. The bottom right, if you look down there, tax benefit, it does take into account, we used a tax bracket of an average household that makes about $150,000 a year.
Okay.
100 to 150,000 average tax bracket based on what taxes are today. So, I mean, look, this will get as fancy as you want. And we had to make a lot of assumptions, like what tax bracket are you in? How much would your rent be? How much do we think rent will increase? How much do we think the home will increase? But I wanted to really dumb it down in the sense of being as conservative as possible so that we're not overestimating and painting a rosier picture than what it really likely would be.
So when I show this to anyone, this is just one scenario of many, but this is just, we feel, a very conservative scenario. And a lot of these assumptions, they don't have to be this way. Some of these things can be variable and all that. So that's great. But one thing I heard someone also say, the reason why renting or buying versus renting can be good too, it's a forced savings plan, which I always thought was awesome just to think about that. So
I love that. Yeah, it forces you to pay down your loan over time, and it's a forced savings plan. Absolutely.
Okay. Well, thank you for this. I know you did one too on 400,000. So we have these for anyone who kind of want to look at this and what that is. But yeah, this data is just awesome. So this kind of shows the whole thing, because we really take it upon ourselves as we're not just salespeople like from the real estate side. We really want to be people's real estate financial advisor. Like we've been in real estate, like you said, for almost 2 decades, and we love going after it, but love showing people the big picture. And so again, I always say it's not for everybody. But for those who are stable, have a good job, they know that they're going to kind of be there and they're going to be in this location for a little while. Like this is something that can bless people for a long time to come. So.
Absolutely. I have a recent story, in fact, from this week, Robert, where I talked to a lady, and she's a server. She works at a restaurant, and COVID was kind of tough during that period of time, right? And she ran up some bills, but she had a home on the east side of Austin, and she bought it 10 years ago for about $250,000 and just sold it and cleared $300,000. And she's like, hey, I got $300,000. I make $8 an hour plus tips, and I work a couple different jobs, and can I qualify for a mortgage? And it was really tricky. And there may be a way to qualify for a mortgage, but after really discussing it for her, it made more sense for her to hang on to that cash and to save for her retirement and just keep renting rather than needing to put all 300 down to be able to qualify for a mortgage. And so you had said it a couple of times already that, hey, it's not for everybody, and we understand that. And it's a privilege to own a home. It's a big responsibility to own a home. And I love that about you and your team, Robert, is that, you guys will tell people not to sell. You'll tell people not to buy if you genuinely feel like that's within their best interest. And of course, that's our commitment as well.
And I appreciate that about you. And that is our heartbeat. Yeah, I think when we do that, just you gain the trust of people, and they know, and they can have us as advisors forever, and we'll tell them the truth. And then, yeah, it's just, it makes what we do every day worth it. And so thank you for being that way as well. Can I show this chart as well? The Fed chart for the interest rate?
Oh, sure. Pull that up. Just give a little context on interest rates and where they've been.
Yes. So
Yeah,
what,
when did you get in the business, Robert?
2005.
Okay.
So right here.
Right there. Perfect. I got in the business about 4 or 5 years before that. And so you got in the business and rates were about where they are now, high fives, almost 6%. I got in the business in February 01, and rates dipped below 8% for the first time. And if you go back and look, the first time in 25 years that rates were below 8% for the most part. If you scroll left, all the way left, like 1995, they're in the 9s, and in the 80s, they were unbelievable, 18%.
That's
Gas
great.
prices, the gas prices were not what they are today, but when you adjust for time and adjust for people's wages, right? They're what they live on, their lifestyle. Gas was really expensive then, and rates were at 18%. And gas is higher now, but rates aren't anywhere near 18%. I mean, I can't imagine what that would have been like and people were still buying homes at interest rates of, 12. If you go to the right, you'll see 15. And then at the peak, I think you'll see 18%. I mean, it's unbelievable.
Wow. We're not going there, are we?
We're not going there. No way.
Fair enough. Yeah. But no, this does put it in perspective. And I mean, just over the last years, like you said, the last decade, like it's been quite amazing, and the lowest it's ever been. But relatively speaking, 6% is kind of where they want it to be. Is that right?
Yeah, I think that's probably a healthy kind of range. I look back at the 20 years I've been doing this, and rates probably averaged about 5%. But for a lot of the first 10 years I was in the business, rates were in the 6% range on average. It's certainly familiar territory.
Okay. The only other questions I have is just because we'll have people ask this as well, is certain, and I know this is very contingent upon everything, but a lot of people say, we've seen a lot of people who thought that they could qualify, and they're like, well, I thought my credit score was too low. Is there a certain credit score they should aim for, or just, I mean, we always say just call Carson and let him kind of talk you through it or whatever, but what can you, any light you can shed on that?
Yeah, that's a great question. And I think it's important to remember it's never too early to get started with getting pre-qualified. And it doesn't cost you anything. We'll run a credit report for you. We'll educate you on, hey, here's what it would cost to get into a home at this price. Here's where your credit scores are now. Here's how much you could afford now. And if you do have some challenges on your credit, getting to you early gives us the opportunity to work on fixing a few of those things. So I can tell you every single month, there's more than 5 or 6 folks that we help with getting a medical collection deleted. We just tell them they can do it themselves. So we just tell them, hey, here's the number off your credit report. Here's what you need to call and ask for. And here's how to accomplish that. And then once you get the documentation that it's been removed, we can help forward it on to the credit bureaus to get that item deleted and get you rescored and get your credit scores up. But if you come to me already under contract, for example, or your lease is up in the next 30 days, it doesn't give us as much time to work on some credit scenarios to help get that credit score. So I guess the bottom line is never too early to get started. And it's not as painful as what you think it might be. And yes, we have folks that are told no all the time. And we come in and show them, rather than telling them that we can't help them with the mortgage, we will always show them a path to home ownership. Hey, here's what we will need to do. We'll need to take these steps. It's a no right now, but over the next 6 months, if you can do these 3 things, then that'll put you in a position where you're more likely to be able to buy a home.
And we just had a buyer the other day. They're like, I'll go get pre-qualified. We're going to slowly look, but we're not buying anytime soon. And we said, okay. And they sure did you got them qualified right away. And I think it was a day or 2 later, they're like, this is the one. And so, but luckily they did it earlier than what they thought they needed to. And so they can come in with a strong pre-approval letter. And what about jumbo loans. People are thinking, are those, how do those rates compare to the normal rates?
Yeah, it's a good question. What makes a jumbo loan is just the size of the loan, right? And that number changes each year. And right now, that number is about 650,000. It's like 647,250, right?
Anything
But
anything over
anything
that?
that's
Okay.
correct. So anything over $650,000 would be considered a jumbo loan. And jumbo loans are different in the sense that they're not Fannie Mae and Freddie Mac loans, and they don't the rates the rates are driven by something different than what the non-jumbo rates are driven by. And so as rates have gone up, we've seen this scenario where jumbo rates are actually lower than a conventional rate. And historically speaking, jumbo loans are riskier, meaning a bank's lending you $2 million and it's one borrower, let's say, in one house, compared to that same bank making 10 loans, right, to 10 different homes and 10 different borrowers, and the chance of one of those loans being bad is there's less risk because there's more diversification. So it's really unusual that rates are lower right now on a jumbo loan, but that's because we're back into a territory where there's an appetite to make a jumbo loan. The Wall Street and institutional investors, as banks, use their money to make that loan instead of Fannie Mae and Freddie Mac guaranteed kind of loans. And so the rates are lower. They're in the mid fives, let's just say on average, instead of the low sixes on a jumbo versus a conforming, and usually that's flip-flopped.
Okay. And last question is, someone, I think you educated either one of our buyers or agents the other day, just because we definitely had a client asking, like, well, is now a good time for an ARM? And I think you said, well, actually, no, and here's why, but explain that.
Yeah, so an ARM is an adjustable rate mortgage, and what that means is the rate that you lock in right now is only fixed for a certain amount of time, and that certain amount of time can be 3 years, 5 years, 7 years, 10 years. And the idea is that in exchange for getting a shorter term commitment, that the rate would be better. So there needs to be an opportunity for you to get a lower rate to not lock in a 30-year loan. And under either scenario, I do think we'll see lower rates than where we're at now. I mean, I don't have a crystal ball. So in theory, an adjustable mortgage doesn't scare me, right? But it needs to make sense. In other words, you would want to get a better rate by at least 0.5% or so for it to make 1/4 to 0.5% for it to make sense to do an adjustable mortgage. But because of the economics of it and what the market thinks is going to happen over the next few years, the rates on the adjustables aren't really much better, if any, on a conforming loan. On the jumbo side, we're seeing a little bit of a spread between the rate that you would get on a 30-year versus an adjustable mortgage.
Okay, so those maybe if people are educated and wise and know how those work, but that may be an option there. Okay.
What's true this week may be different next week too.
That's really true.
The markets are always changing.
It's kind of like the weather in Texas. If you don't like the weather in Texas, just wait 5 minutes. You'll be good.
That's right.
Unless if it's summer. Overall, though, I think the message that we've been hearing people say that if you are truly in the market to buy, there's great hope for buyers right now. Not all houses, but most houses, you don't have to compete. You don't have to necessarily do the appraisal waivers. You're having more. You can now get into a home where it's been very hard the last 2 years. You can get in with little money down, and in some instances, no money down. And so those buyers are looking up and saying, this is an opportunity. Plus, we know we have tons of people relocating here. And so all of them are saying, well, we got to get a home, and we know what real estate does. And so any other closing thoughts?
Yeah, so I love that you said that. And it certainly puts you in a better position to be able to win, to get an offer accepted if you're not competing with a bunch of other buyers. And the longer a home sits on the market, the more willing, typically, I mean, this is your department, not mine, but more typically the seller is motivated to sell a home. And so in some cases, we're starting to see price reductions on homes that were priced really high. So if you were to look at, okay, is now the right time? There's an argument to be made that yes, because you're not going to likely get into a big bidding war and have to overpay. And in some cases, you might be able to get that same house at a little bit of a discount. And then the real disadvantage of the timing right now is that, hey, rates are higher than what they were a few months ago. And it's probably worth mentioning, there is an opportunity to buy your interest rate down. And maybe now more than ever, we might find a seller that we could negotiate for them to contribute that money. And you'll want to talk to Robert and his team because it's case-by-case basis on the specific home, and it would need to take into account how long it's been on the market and how's it priced. But if a home's been on the market at a certain price, let's say $500,000, rather than offering $490,000, we could give them the $500,000 and ask them to pay $10,000 towards your closing costs. And we could use that $10,000 to either buy down your interest rate, save you a couple $100 a month, or that could reduce what you're having to pay in terms of closing costs, and you could put that 10 grand aside. And Robert, that would go a long ways to covering that $400 or $500 more payment, right? That would cover the next few years until such time as maybe rates come down and we get to refinance you.
And it's funny, you were talking, I wrote that down. I wanted to ask about buy down rates. So that's perfect. And we can ask you more questions about that as needed. But the fact that that's a tool in the tool belt for buyers now, I think that's a big deal.
Mm-hmm. Awesome. I really appreciate you having me on today.
For sure. I appreciate you as always, Carson. So thank you.
Okay, very good. Thank you, sir. Take care.
You too.
Bye.